hit the like button, subscribe to my channel, and invite others. Warm welcome to my channel, the Desi Analyst. And finally, the wait is over, and your most favorite topic is here. Before starting with technical analysis, first understand two main things. This is very important. First is it's pure educational base and you understand or not. Follow everything and don't skip or miss out any single video or any single minute of it. Whether you know it or you have rough idea of technical analysis, do not skip at all. The technical analysis is a series on professional basis, which is important and will be continued in Desi style. But for Desi style, you need to watch this series, then you will be able to understand easily because everything is bit connected. So for learning in Desi style, first you have to go through this technical analysis series. So let us start with technical analysis series part 1. Technical analysis introduction. The methods used to analyze securities and make investment decisions fall into two very broad categories: fundamental analysis and technical analysis. Fundamental analysis involves analyzing the characteristics of a company in order to estimate its value. Technical analysis takes a completely different approach. It does not care one bit about the value of a company or a commodity. Technicians, sometimes called chartists, that is, chartists, technicians, are only interested in the price movements in the market. Despite all the fancy and exotic tools it employs, technical analysis really just studies supply and demand in a market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the market by studying the market itself as opposed to its components. If you understand the benefits and limitations of technical analysis, it can give you a new set of tools or skills that will enable you to be a better trader or investor. In this tutorial, we will introduce you to the subject of technical analysis. It's a broad topic, so we will just cover the basics, providing you with the foundation. You will need to understand more advanced concepts down the road. Means in the series, I will cover up, but we will go step by step. Technical analysis, the basic assumptions. What is technical analysis? Technical analysis is a method of evaluating securities by analyzing the statistics generated by market activity such as past prices and volume. Technical analysis do not attempt to measure a security in string value but instead use charts and other tools to identify patterns that can suggest future activity. Just as there are many investment styles on the fundamental side, there are also many different types of technical traders. Some rely on chart patterns, others use technical indicators and oscillators, and most use some combinations of both or of the two. In any case, technical analyst exclusive use of historical price and volume data is what separates them from their fundamental counterparts. Unlike fundamental analysts, technical analysts don't care whether a stock is undervalued. The only thing that matters is a security's past trading data and what information this data can provide about where the security might move in the future. The field of technical analysis is based on three assumptions. First is the market discounts everything. Second, Price moves in trends. Third, history tends to repeat itself. The market discount everything. A major criticism of technical analysis is that it only considers price movement, ignoring the fundamental factors of the company. However, technical analysis assumes that at any given time, a stock price reflects everything that has or could affect the company, including fundamental factors. Technical analysts believe that the company's fundamentals, along with broader economic factors and market psychology, all priced into the stock, removing the need to actually consider these factors separately. This only leaves the analysis of price movement, which technical theory views as a product of the supply and demand for a particular stock in the market. Price moves in trends. In technical analysis, price movement are believed to follow trends. This means that after a trend has been established, the future price movement is more likely to be in the same direction as the trend than to be against it. Most technical trading strategies are based on this assumption. Third is history tends to repeat itself. Another important idea in technical analysis is that history tends to repeat itself, mainly in terms of price movement. The repetitive nature of price movement is attributed to market psychology. In other words, market participants tend to provide a consistent reaction to similar market stimuli over time. Technical analysis uses chart patterns to analyze market movement and understand trends. Although many of these charts have been used for more than 100 years, they are still believed to be relevant because they illustrate patterns in price movement that often repeat themselves. Not just for stocks. Technical analysis can be used on any security with historical trading data. This includes stocks, futures, commodities, fixed income securities, forex, etc. In this tutorial, we will usually analyze stocks in our example, but keep in mind that these concepts can be applied to any type of security. In fact, technical analysis is more frequently associated with commodities and forex, where the participants are predominantly traders. Now that you understand the philosophy behind technical analysis, we will get into explaining how it really works. One of the best ways to understand what technical analysis is and is not is to compare it to fundamental versus technical analysis. Technical analysis and fundamental analysis are the two main schools of thoughts in the financial markets. As we have mentioned, technical analysis looks at the price movement of a security and uses this data to predict its future price movement. Fundamental analysis, on the other hand, looks at economic factors known as fundamentals. Let's get into the detail of how these two approaches differ, the criticism against technical analysis, and how technical and fundamental analysis can be used together to analyze securities. The difference is charts versus financial statement. At the most basic level, a technical analyst approach a security from the charts, while a fundamental analyst starts with the financial statements. By looking at the balance sheet, cash flow statement, and income statement, a fundamental analyst tries to determine the company's value in financial terms. An analyst attempt to measure a company's intrinsic value. In this approach, investment decisions are fairly easy to make. If the price of a stock trades below its intrinsic value, it's a good investment. Although this is an oversimplification, that is, fundamental analysis goes beyond just the financial statement. For the purpose of this tutorial, this simple tenet holds true. Technical traders, on the other hand, believe there is no reason to analyze a company's fundamentals because these all are accounted for in the stock price. Technicians believe that all the information they need about a stock can be found in its charts. Time horizon. Fundamental analysis takes a relatively long term approach to analyzing the market compared to technical analysis. While technical analysis can be used on a time frame of weeks, days, or even minutes, fundamental analysis often looks at data over a number of years. The different time frames that these two approaches use is a result of the nature of the investing style to which they each adhere. It can take a long time for a company's value to be reflected in the market. So, when a fundamental analyst estimates intrinsic value, a gain is not realized until the stock market price rises to its correct value. This type of investing is called value investing and assume that the short term market is wrong but that the price of a particular stock will correct itself over the long run. This long run can represent a time frame of as long as several years in some cases. Furthermore, the numbers that a fundamentalist analyze are only released over long periods of time. Financial statements are filed quarterly, and changes in earning per share don't emerge on a daily basis like price and volume information. Also, remember that fundamentals are the actual characteristics of a business. New management can't implement sweeping changes overnight, and it takes time to create new products, marketing campaigns, supply chains, etc. Part of the reason that fundamental analysis use a long term time frame, therefore, is because the data they use to analyze a stock is generated much more slowly than the price and volume data used by a technical analyst. Trading versus investing. Not only is technical analysis more short term in nature than fundamental analysis, but the goal of a purchase or sale of a stock are usually different for each approach. In general, technical analysis is used for a trade, whereas fundamental analysis is used to make an investment. Investors buy assets they believe can increase in value, while trading buy assets they believe they can sell to somebody else at a greater price. The line between a trade and investment can be blurry, but it does characterize a difference between the two schools, that is, technical and fundamental. Much of the criticism of technical analysis has its roots in academic theory, specifically the efficient market hypothesis (EMH). This theory says that the market price is always the correct one. Any past trading information is already reflected in the price of the stock, and therefore, any analysis to find undervalued securities is useless. In the first, called weak from efficiency, all past price information is already included in the current price. According to weak from efficiency, technical analysis can't predict future movements because all past information has already been accounted for, and therefore analyzing the stock's past price movement will provide no insight into its future movements. In the second, semi strong form efficiency, the fundamental analysis is also claimed to be of little use in finding investing investment opportunities. The third is strong form efficiency, which states that all information in market is accounted for in a stock's price, and neither technical nor fundamental analysis can provide investors with an edge. The vast majority of academics believe in at least the weak version of EMH, that is efficiency. Therefore, from their point of view, if technical analysis works, market efficiency will be called into question. So, with this first part of the series, I am going very slowly and will increase the speed as per the necessity and as per your learning abilities. And hopefully the series will continue on every weekend, and you have to watch it without skipping anything, whether you understand or whether you don't understand. So please, I again request, whether you understand or don't understand, do watch each and every second of the video. Don't skip anything, don't skip a single part of the series. The technical analysis series will be very useful once it is completed, and when the Desi style of technical analysis will come, that time you will be at very ease. So watching this is mandatory and skipping is not allowed. And I personally request you all to watch each and every part of the series. So hopefully we'll continue next weekend. Till that, I hope you will learn a lot from here and invite others also and help others also to join my channel and start from the starting of the technical analysis series itself. Thank you all.